Hi and welcome to this episode of OmniTalk. Today we are discussing a very common financial ratio, which is PE, price to earnings ratio. Now this ratio is, quite like people are quite familiar with the ratio, and it's heavily used but heavily abused also at the same time.
Familiarity breeds contempt, right?
Correct, right. So it's so common that I believe that a lot of people have kind of just abandoned that. Okay, PE is useless, and we have seen a lot of instances there. Even let's say a 5 PE is not like a right metric to look at the valuation of a company, and it could be a value trap,
Right.
right? And one can easily justify, let's say, 100 PE or a 150 or even higher. And then people, or typically people might be extremely puzzled that, okay, what is this number? It can be anywhere and everywhere, and still can I make a head sense of this particular ratio at all? And so we thought that we personally believe that it's a very good kind of a thumb rule to go by. Can give you a lot of insight. It's a crude way to kind of estimate a valuation ratio, but still extremely powerful, I believe.
Yes.
And that's why we thought that let's just talk about PE ratio and try to kind of highlight how to go about, how to approach this particular ratio. So I'll just put down the how do you calculate it. It's a very simple calculation. It is the market capitalization of a company, and you divide it with the earnings, and that's where you get the PE ratio. There are two formats which are popular, like TTM PE, which is trailing 12 months, and forward 12 months. So that's a forward PE and a trailing PE. What are the difference in these two? Also, we'll try and touch upon. But because let's try to decode what PE means, or how can it be used and why it is a powerful tool.
Yeah. So see, all investing is value investing or buying things at a discount to intrinsic value. Right. And the way to do intrinsic value is using the discounted cash flow.
Sure.
So where the three things come into play: the future cash flows
Yeah.
from now till infinity. Second is the growth rate. I mean, so to project the future cash flows, there is a growth rate, right? The current cash flow of next year, and then the growth rate. So this takes care of the future cash flows.
True.
And this is divided by the discount rate, right? The present value using discount. So three things come into play, which is current cash flow, growth rate, and the discount rate.
Right.
Now, instead of cash flow, people replace it with earnings. Right. So that's how it. So price, intrinsic price, is equal to this, where right side there is current cash flow, growth rate, and in the denominator there is
discount
rate. So these three things are there. Instead of cash flow, when you replace with earnings and then you put it down here, then you get the PE ratio.
Right.
So
it's basically the kind of discounted cash flow variant
of way of summarizing the DCF. Right. And what you're implicitly trying to do when you say something is low PE, you are saying its intrinsic PE is higher.
Right.
Ideal PE of that company is, let's say, 25. You are getting it for 18. So that's a discount to its, and so it's cheap. And so we can buy it.
True.
And suppose intrinsic PE is 25 and it's in the market at 40. It is at a premium. So you should sell.
Right. So the variables are earnings, the growth rates, and the discount rate. So I think two adjustments. One, what we someone would need is to, because now the reported numbers are there, right? Correct. The earnings are reported, so that's a number readily available.
Yes.
But that growth is something which is not readily available, right?
Correct.
You have to do a lot of deep dive into what industry, what sector, what Correct. The management is saying, what the Correct. Kind of capital allocation they are doing.
True.
How how big the TAM is, and how they can kind of grow faster than the peer and things Correct. Like that.
Correct.
But before we go there, but on the earning side itself, I think there is a lot of normalization can happen or adjustments,
Correct.
if you could just explain,
Yeah. So let's say there was a tough year for
right,
some industry, right?
right,
And so suddenly they were expecting whatever sales, and slightly lower sales happened.
right.
And so the margins took a hit.
Hmm.
So the net income reported is actually lower
Right.
compared to the revenues. There is a certain percentage which is supposed to flow to the net income.
Sure.
But this year, because of some exceptional situation, the net income reported is less,
Yes. Right.
and so the PE might look high,
Right.
right? And once you normalize it to what, let's say the net margin should have been 10%, but reported was 5%.
Right.
So if you bring it back to 10%, which is the long-term
Right.
net margin, that will be the normalized P.
Okay.
I mean earnings.
Earnings.
And then you do the P on that you will get a more accurate picture of
So
how the
there's
company is
one
getting
reported,
valued.
one is reported PE as per the reported
Hmm.
numbers, and then you make an adjustment on the earnings, and you see, now is it attractive or less attractive, right?
Exactly.
Okay.
Exactly.
So there are uh, certain. So we'll come to then what is attractive and what is not. How do
Sure.
you
Sure.
form a
Sure.
opinion about that? Like
Right.
what PE is a good PE?
See, the basic benchmark, we have the benchmark itself, right?
Yes.
Which
Yeah.
is Nifty or Sensex.
Correct.
Or if you are in mid cap, you can look at the mid cap index, or small cap, you can look at the small cap index, right?
Right.
Whichever part you are in. So first you compare your company's PE, whichever company you are thinking about, with the market PE.
Correct.
Now, if it's below the market PE, then it's probably cheaper.
Right.
Right? Probably, I say. It's an
Right.
indicator that it could be cheaper. If it's at a higher PE, then it could be expensive. So this is the basic thing. Now, what justifies slightly higher PE?
Right.
If you have better margins, better profitability, higher ROE, it could be justified at a higher PE. If you have higher growth rate than the market, that could be justification. Right now, so let's understand the growth rate also.
Right.
Right. Nifty or Sensex or the whole Nifty 500, etc., represents the full Indian economy.
True.
Indian economy grows roughly at 7% real GDP plus 4% inflation.
Right.
Right. So 7 plus 4, 11.
Right.
That's the whole economy, which has slower growing sectors like agriculture and
Right.
unorganized service sector. If you take them out, which are not in the listed space, then it goes to 12 to 14% kind
Right.
of growth rate, right? Nominal. So that's the kind of growth rate you can assume is true for Nifty.
Right.
And then Nifty has certain PE. Now, this company is at a premium to it. So does it have a higher growth rate than this? And that too not for 1 or 2 years.
Like for long, right?
For 10 years, you should have expectation of a higher growth rate on this.
True.
Or at least 5 years, very high growth rates. Then maybe a higher PE is justified.
So when we say higher, like what is the range of, let's say, as per your understanding, or if you want to give them a thumb rule, let's say, so is 20 is a fair PE, or is?
Yeah, I would. It's obviously, I mean, this it cannot be taken as a rule, but
Right.
by and large, for India or even for most other countries, I think 20 is
Right.
a fair thing. Definitely for some country growing at the rate of India, 20 PE seems quite fine.
Right.
Also, the risk-free interest rate.
Right.
So the underlying inflation assumption for future, and thus the risk-free or the RBI interest rate,
right, will
for the future is also part of this equation. If that is going to be significantly lower than the past, then even a 25 PE might be justified for it.
Right.
At the high growth rates we are talking about.
Right.
So somewhere in 20-25 range seems fair.
Yeah.
Now 25 definitely requires that your discount rates or inflation is much lower, while the growth rates are still very high.
Right. So essentially, like once you spot a company or a sector which is at a discount or which is at a very high P multiple, I think the first reaction is to investigate further, right?
Exactly.
Rather than trying to justify that this is okay, this is this is a very high growth sector, so very high is low, or this particular industry always trades at single digit multiple, so this low multiple is fine, or this is is not undervalued, this is the ecosystem for this. So that's, I think that's a first step, that you start investigating that, okay, why it is so high or why it is so low. And then you can kind of potentially find in attractive investment opportunity on both sides, actually, on high PE companies as well as low PE companies. Right? So one more point I think we can discuss is on of certain exceptions that one needs to keep in mind when looking at PE as a number. Right?
So low P, let me address that.
Sure.
High P we addressed, right? How high P is justified is with higher ROE, higher margins, higher growth rates.
Right.
Now low P, on what basis? Low P is fair P. Right. So it's not low.
No, yes.
Right? It's not worth investing.
Right.
Is when there is high leverage.
Right.
Right. So just imagine the house example I'll give.
Right.
When you buy a house that is worth 1 crore, let's say the value of the house is worth 1 crore, you put your 25 lakhs down.
Right.
And 75 lakhs you are financing through the home loan.
Right.
Right. So this 25 rupees is not what you are paying for the house, right?
Correct.
Although that is something similar to the market cap.
Correct.
Equity portion is valued at 25 lakhs. The debt portion, which is not visible in the market cap, but it is still you are paying for the house, that is 75 lakhs.
Right.
And if you do a PE, the PE would be 25 lakhs divided by, let's say you are getting 5 lakh rupees as the rental.
Right.
It doesn't happen, but on a 1 crore house in India, but it should.
Yes.
But anyway, so 25 by 5 lakh, that will be like a 5 PE. And you will say, oh, this is so cheap. But actually it is 1 crore divided by 5, which is a 20 P.
Right.
If you paid all of the money instead of debt, you would pay it as cash.
Right. Then you would have calculated yours PE as 20.
As 20.
Right.
So this is the flaw when people think something looks very cheap. A P, and it looks like a 5 P. It's actually, including the debt, it's probably 20 P.
Correct.
Right. So that's why people call these kind of things value traps.
Correct.
And definitely, so don't use PE in a highly leveraged company. Or you add the debt to market cap when calculating.
Also, I think in cyclical business, this is the challenge that, at the peak of the cycle, the earnings are all high.
Very high.
And then the PE starts looking low.
And
cheap. Then you believe that, okay, this is, very cheap, but that's a trap.
And the recent growth rate is also very high.
Yes, right.
It's higher than the economy.
Right. So you have to look at longer cycle for that.
Right. And the margins are high, ROE
everything
is
is good. And then PE looks cheap.
Yes.
Right.
Yes.
So that's a wrong time to enter.
Yes. So but cyclical, high leverage, these two things we have to be careful when looking at low PE.
Right.
And don't hand wave and justify high PE for high growth.
Right. Right.
Because we have companies, right? Those many companies which are growing at single digits.
Correct.
7-8%, or sometimes even shrinking on some quarters or some years.
Right.
And you are buying them at 50, 70, 100 P.
Right.
It doesn't make sense.
Doesn't make sense. Right. So great. I think should be helpful in understanding and decoding PE as a multiple. If you have any queries, then happy to reach out to us, and we'll be happy to answer that. That's all from our side.
That's all. Thank you.
Thank you. So always keep in mind that investment in securities market are subject to market risks. Read all the related documents carefully before investing. And also that registration granted by SEBI, membership of BASL, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors.